Let's talk about Chapter 12, which is about investing in stocks and bonds. So kind of a continuation of Chapter 11, where we talked about just investing in general and some specific things you can to invest in. But we'll spend some more time just on stocks and bonds in this chapter. You can see here what the learning goals will be about this chapter. And how will this affect me? Of course, part of your financial goals is deciding what specific investments for you to buy, and that's what this chapter is about. And I'll let you look at those on your own. So, risk of investing. So just know that anytime you decide to invest, you're taking on risk. And of course, in exchange for risk, you are hopefully getting a return that matches that risk. But just kind of be thinking about buying stocks or bonds and how these different types of risks will affect that investment. So business risk is basically if you buy stock of a company, it's basically the cash flows and the abilities of that company to meet its expenses on time and just operate as a business and be profitable. Financial risk is about debt. How much debt does a company use to finance activities, and can it pay that debt back on time? So just think about the financial statements of a business itself. Market risk is the behavior of investors in the market, how investors react to economic news, to market forces that will affect how much they're willing to pay for a security, and stock prices will go up and down. The last one is purchasing power risk, which changes the general level of prices that can impact the ability of a firm to operate. So basically just its power to operate in the economy, just knowing that economic forces will affect certain companies in different ways depending on if we have a economy that's going up or down or whatever. Other types of risk or interest rate risk. If you invest in bonds, you earn a fixed rate of interest on those bonds. So there's a risk if interest rates change, going up or down. Liquidity risk is owning an investment and not being able to liquidate or sell that investment easily or quickly. And event risk is just the risk of something unexpected happening that would impact a particular company or industry and maybe have negative effect then on your particular company. So it could be something like regulation, it could be a weather event, it could be an earthquake, it could be just an economic collapse happening in another part of the world. Some companies are more subject to those types of things affecting their operations than others. So when you invest, of course, you expect to get a return. If you buy stocks or bonds, you're receiving either dividends or interest. If you own real estate, you would get rents from your real estate. If you're buying into commercial or residential property, clearly you're doing so to get rents back. Capital gains are buying an investment at one price, having it go up in value and selling it at a higher value, a higher price at some point in the future. And interest on interest is the power of compounding. Basically, you earn interest, you reinvest it, and you earn interest on your interest over a long period of time. This just shows you interest earned on a bond. So let's just say you put $1,000 down on a bond. You buy a $1,000 bond, and in 20 years, if you earn either 3% or 4% interest, here is what you will receive over that period of time. The risk-return trade-off, again, anytime you choose to invest, as you seek higher rates of return, you are trading higher risk and then getting just kind of trying to find that match of risk and return. So if you want a higher return, you must be exposed to greater risk. Most people have some level of risk aversion. They don't like taking risks. So you have to find a balance, right? What's the right mix of risk for you, depending on your age and your goals that you're saving for. What they call the risk-free rate of return is generally tied to a U.S. Treasury bill, and generally very short term. and it's considered to be risk-free, and it's very low rate. Right now, about 1.8%, give or take a few basis points. But lately that's what it's been. And this shows you that here. This does not give you the actual rates of return, but it just shows you that if you choose point A on this chart, you are at a very low interest rate with zero risk if you are the U.S. Treasury bills. And then as you take on more risk with different types of investments, then you are exchanging that risk for higher return. Okay, so that's this where you're at. So, most people get a mix of investments. They'll, have some money in very safe. They'll have some money in riskier, and somewhere in between. So a lot of people try to find a portfolio that balances risk, and you don't have all of your investments in one type of investment. So what makes a good investment? Basically something that will get you the expected return. Okay, you buy an investment based on expected future returns. You kind of have to look at the past to judge the future, but you make an investment expecting to receive something. You expect to receive dividends or interest or some kind of price appreciation. Okay, now what you expect and what actually happens don't always work out because the expectation implies future, and none of us can predict the future clearly. So the expected yield of investment, you can see here the formula for that. And you won't be doing this a whole lot, excuse me, in Cengage. In Cengage, you'll be doing, you might use this formula for a problem, but you'll be doing some ratio analysis also. There's 3 problems in Cengage for this chapter. There are no worksheets for this chapter provided by the author, but you might just need this formula. So just kind of FYI, just make a note of that. But you can see here how to compute the expected return. Your average annual current income plus the future price minus the current price divided by the number of years, and then you take that and divide that by the current price plus future price divided by 2. And of course, when you are putting in future price, if you're kind of trying to, if you're making an investment based on expected yield, you're guessing the future, right? So what you put in there for future isn't necessarily known because you would have to estimate what that would be. So most investors, before they buy an investment, will have what they call a required rate of return, which is basically the amount of return that you need to match the amount of risk that you take in buying that particular investment. Of course, you could just go completely risk-free, get a U.S. Treasury bond. You can buy CDs that are insured. Very low rates of return, but zero risk. So what the whole point, though, is to find investments that match or exceed the required rate of return, whatever that is. If it's a stock, a bond, whatever the investment is on that continuum of investments, we just want to match risk and return the best that we can. So investing in common stock, it says here each share represents equity or part ownership in a company. You basically are participating in profits. If the company is profitable, there's a good chance that they will pay dividends. And if they're profitable, that means the stock price will generally go up. You can see here it says that stock ownership is residual. Its shareholders have a residual interest in corporate profits, basically saying that you have kind of a percent ownership of the profits of the company. Of course, the firm must pay all of its bills and debts too, but you have an ownership interest to a degree in the company. This just shows you if you went into 2006 and you started out with a $10,000 investment in stocks, how that would have changed over the years based on 2 different stock indexes, the NASDAQ and the Dow Jones Industrial Average. And you can see that they're very correlated. They go up and down generally in the same patterns with a few differences here and there because they're just different companies in each one. But you can see that if you had $10,000 invested in 2005 at the end of 2015, you'd be worth 26,000 in the NASDAQ, actually 25,450, and 22,031 in the Dow Jones. You can see here, that's the thing about stocks, is they have more risk, because while you generally get a decent return over a long period of time, individual years may be good or bad. You have to kind of weather the bad years with the good years, and 2008 was an abnormally bad year. The second worst year since 1825, as we mentioned in a previous chapter. Tax needs to be considered when you invest also. There are tax consequences to many types of investments that you can make. Gains on a stock are not taxed until they're actually sold, so a stock can go up in value, but you would never pay the tax on that gain until you actually sell the stock and realize the cash. Dividends are taxed. It depends on what your tax bracket is for dividends. Basically down here it says if your tax rate is, and what your capital gains tax is to qualified dividends from domestic corporations and long-term capital gains are taxed at a maximum rate that varies with the regular tax rate. You can see here you're taxed based on your tax bracket. If you're at the highest tax bracket, you pay 20%. If you're in the 25 to 35% range, that's 15%. If you're 15% or lower, you pay zero tax in those items. So dividends, when a company declares dividends, the board of directors must declare those dividends. It tends to be the same amount per year. Some companies try to be intentional about having small increases year over year. They're paid quarterly. They could be paid annually. Some companies pay twice per year, once per year, or 4 times per year. There's really no right or wrong to it, just what the company wants to do. Generally, dividends will be 0 to 6% of a stock price. If you find a company that is paying around 6% of its dividends compared to price, that's actually not a bad deal. That's pretty good yield. If the stock price is low, dividend rate could be high until the board adjusts the dividends paid. So obviously if the stock price comes down and the dividends don't change, the yield will go up. So the yield is calculated as dividend received per share divided by market price per share. And that's a formula you will be using when you do the Cengage Now problems. Just be aware of that. Key performance measures. So as you try to evaluate a stock investment, one of the questions, of course, is how do you decide what company stock to buy? That's one of the biggest questions out there. And so one of these is you have the book value of a stock of a company is literally its assets minus its liabilities, and that's what they call the book value. And you find that number from looking at financial statements of the company, just looking at per the financial statements, how much assets are there, how many liabilities are there, and the difference is book value. Net profit margin is simply profits divided by sales. Basically telling you what percent of sales turn into a dollar profit. The return on equity is taking your net income and dividing that by shareholders' equity. So those items that you see here literally are coming from the financial statements of a company. The income statement and the balance sheet and the statement of equity all go into calculating these ratios. Another ratio to think about is earnings per share, or EPS. You can see the formula here. You're taking profit after tax, subtracting out preferred dividends, and dividing that by the number of shares of common stock. And this is a required disclosure on financial statements that companies have to provide and issue. But it basically just says if you own a share of stock of that company, how many earnings belong to you. Now, they won't be paid to you necessarily, but you can kind of just say this stock represents, X dollars worth of earnings. A really good ratio that investors like to look at is what's called the PE ratio, price to earnings. And what this does is it's a market price of stock divided by earnings per share. So the previous screen, the earnings per share, we just take market price divided by earnings per share, and that gives us the PE ratio. And what this means is it's a measurement of confidence and expectations that investors have about a company. The higher this ratio, typically the better, although a ratio can be too high. Ratios are really, really high. That means there's a lot of speculation about the stock. But typically, The average ratio it says for the S&P 500 is 15. I've had people who are professional investors tell me that they try not to buy a stock that has a PE ratio above 20. Once you get to a higher PE ratio, there's typically more risk with a particular investment. Beta is a way to actually measure the risk of a stock, and beta measures how will a stock move as the market moves. So it's a measurement of volatility, which includes a measurement of risk. It's a way to try to take risk and boil it down to an actual number. So a beta less than 1 has low price volatility, and a beta above 1 has higher price volatility. And so just know that the market's beta is 1. So we're comparing an individual stock to the market. And again, a beta above 1 is higher volatility. A beta below 1 is lower volatility. And of course, that signifies risk. Clearly we're trying to measure risk here. So types of common stock, there's all kinds. Blue chips are considered to be the very large, well-established companies that pay dividends, have very stable in earnings, and do very, very well. Typically not very risky. A growth stock is a stock that is kind of growing more than normal in terms of operations and earnings. Growth stocks typically don't pay dividends or just a very low amount of dividends. They typically have a high PE ratio, and usually the beta is above 1. Tech stocks are just simply stocks based on the technology sector. We all probably should be aware that the technology sector typically has more risk in it than many other sectors because technology is changing all the time. There's a lot of startups that happen every year based on some new technology. Well, that technology doesn't always take off, and clearly some tech stocks have done very, very well and have been around a long time. You can think of a Google and a Microsoft as a couple of examples of those, but many more are newer and emerging, and it's not quite the same for them. An income stock is a stock that has stable earnings and pays a high dividend, typically a safer stock with a lower beta. And a speculative stock typically is for a higher risk company, a newer company that doesn't have a lot of history, doesn't pay a dividend, maybe is not profitable yet, maybe in a newer industry, typically very risky, and typically the beta would be above 1. A cyclical stock is a stock that moves in the same direction as the business cycle. These stocks are in basic industries and typically have a positive beta. An example of those would be automobile companies, maybe some of the bigger airline companies. As the economy goes up, those stocks would go up. If the economy is in a decline, those stocks would go down. A defensive stock is expected to be stable kind of when the economy is down. A defensive stock will at least be stable or do okay, and it will maybe react the opposite way of many other stocks. If the economy is going down, that stock maybe hold steady or go up a little bit. Walmart's one of the classic examples of a defensive stock, and believe it or not, McDonald's is too. Other types of common stock, there's lots of ways to categorize stock. There's all kinds of ways to do this. A large cap is a stock with a very large capitalization, basically the value of the stock being traded actively. 10 billion would be a large cap. Mid cap is 2 to 10 billion. Small cap, 2 billion does not sound small, but it is in terms of a company in the stock market. Mid caps provide a stable return. Small caps, you're really just trying to find some home runs there. You're finding stocks that have high potential returns, but there's going to be more risk with those also. It's actually possible to buy foreign stocks if you really want to. You can, it gives you some diversity. However, if you do buy a foreign stock, you have to be concerned about currency exchanges. The reasons to invest in common stock: to use the stock as a warehouse of value, to accumulate capital, and provide a source of income. Typically, I showed you from Chapter 11, there was a chart that showed you what the average return was on the stock market over certain periods of time, and they're generally pretty good. You can look at some 5 to 10 year periods of time where the market's grown by 10% or more. Some periods are less than that and some periods are negative, but generally over time the market typically gets you a return of around 8%. It's really hard to find other investments that will get you 8%. So that's why the market's popular and why people invest in it. So advantages of investing in capital stock, I'm sorry, common stock. The returns can be very good. Very easy to buy and sell. It's literally a click, right? You can log on with your phone, your tablet, your computer, and you can make a trade in a heartbeat. No direct management is needed, and company info is widely published. You can get the financials, you can get the information very, very easily. The risk would be disadvantages is risk. The prices fluctuate a lot. You kind of have to sometimes just hold your breath. And maybe when you know the economy is not doing so well, just don't look at your statement for a month or two. And don't obsess about it. Just know that it will come back. It always has. It always will. And it's hard to time the purchases. To try to catch the market going up or down the right way. And not all companies pay dividends consistently either. So as you kind of decide what stock to buy, this class is just touching on the edge of how to do that. You can take another class that will do a much deeper dive into figure out how to buy a company. But a viable investment is just one that generates a sufficient attractive rate of return to compensate you for the risk that you're taking in buying that investment. So you want to look for a stock that you think is a good buy and provides value for the money you're investing. The purchase decision quite often is based on what you expect for future cash flows, which are used to compute expected rate of return that you compare to required rate of return to make a purchase decision. So typically what you're doing is you're kind of doing a projection or a future guess about what you think the return of that investment will be, and if that meets or exceeds what you require, you would buy that. But the challenging part is guessing what those future returns will actually be, because none of us can predict the future, so you have to make educated guesses, which don't always turn out the way that you want them to. So what you can do is gather 3 to 5 years worth of performance data, including stock prices and some key ratios about a particular company, like return on equity, profit margin, dividend yield, and earnings per share. Forecast is the future stock price. Value Line reports 3 years of future forecasts. You can go to valueline.com and look at that. The timing of the investment. Don't buy if you think the market's going to be heading down in the near term, or if you feel uncomfortable with the tone of the market. If you're just not sure if the market is what I want to get into at this moment in time. Most people feel that you should make steady investments and not time the market, so that you're kind of averaging out your investments. So instead of just making a couple of big lump sum purchases during a year, make several smaller purchases throughout the year of investments to kind of average out your pricing. You can do what they call the dividend reinvestment plan, where you can actually just go to a company directly. I mentioned that in a previous chapter, and open an investment account with that company, send them your money, and then they will buy the stock for you. And then every time they pay dividends, they will just use those dividends to buy more shares of stock in the company for you. So that was about investing in bonds. Let's talk about stocks also. And it says here, I'm sorry, bonds. We talked about stocks, let's talk about bonds. The reason you buy a bond is the current income in the form of interest, which is taxed at your ordinary income rate. So you just tax at whatever tax bracket you're in, is how they figured that out. Also, they can't provide capital gains. If interest rates go down, a bond becomes more valuable. So bond values are very determined on current interest rates. Provides a preservation of capital, helps diversify your portfolio, but relative to stocks offers a lower return. But what some investors will do is, instead of putting all of your investments in the stock market, depending on your age, if you're younger, maybe 20% bonds, 80% stocks makes more sense. But then as you get older, as you get nearer retirement, maybe even slowly shift to more bonds and go maybe more 80 to 90% bonds and only 10 to 20% in the market. So that's generally what a lot of people do. That's a very simplified example, but an investment advisor probably tell you something along those lines. This just tells you the returns of bonds versus stocks over a period of time, and you can see that they don't always correlate. The stock market has a lot more fluctuation in it than the bond market does. You can see that for sure. They do not always move in the same direction either. So bond characteristics, bonds are a liability to the issuer and a receivable to the bondholder. So if you invest in bonds, if you buy a bond, the company you bought that bond from or the government you bought that bond from now owes you principal. It's just like a loan. It's just like you lent money to a company or a government, and now they need to pay you back along with interest. Interest is typically paid every 6 months. What's what they call the coupon rate is the interest rate that's paid, and the maturity date is when the bond matures and the principal is due. So bonds have a par value. Typically, it's $1,000 per bond. Bonds may be issued at a discount or a premium. It all depends on what the stated rate of interest is versus what the market rate of interest is. Bonds can either be a senior secured bond. It's secured by some asset. So if the company goes bankrupt, there's assets set aside to pay for those bonds. So they don't have much risk. Or a junior bond, which is not secured by any specific asset. It's just backed by the good faith of the company that issued it. So clearly that would have more risk in it. Bonds also could potentially have a sinking fund, which is a repayment schedule to pay off the issue. Basically, a bond with a sinking fund, the company that issued that bond is setting money aside regularly to help pay off the bonds. Some bonds can be callable. That means the issuer has the right to call them back before they mature. It's a way for the bond issuer to protect themselves against interest rates changing. If interest rates drop, they will want to refinance the bond issue, and if the bonds have a call provision, that makes that easier. You can see here also that bonds can be non-callable, and they can also be deferred call, which means it can't be called until a certain amount of time happens or goes past the initial issue time. There's 4 segments of the bond market. 3 of those involve governments, and 1 just general corporations that might issue bonds. Treasury bonds are issued by the U.S. government, considered to be risk-free. They have maturities of up to 20 to 30 years, $1,000 par. They're never callable. Treasury notes are shorter. They are typically 2, 3, 5, or 10 years. T-bills are less than 2 years. You can also buy what they call a Treasury inflation bond, sometimes called a TIP, Treasury Inflation Protection Bond. They have interest and they're adjusted with inflation. So if inflation changes and affects your earnings, you get compensated for that. Typically, interest on federal bonds are exempt from state taxes, but not from federal taxes. Agency bonds are obligations of a political subdivision of the U.S. government, but they're not obligations of the U.S. Treasury. There's some, the Federal Home Loan Mortgage, Government National Mortgage Association. Those would be agencies of the U.S. government that have the power to issue bonds, and they issue those bonds so that people can buy homes, essentially. It's a way to help finance people getting into homes. A municipal bond is issued by a state or local government, such as a county, a city, a school district, and they are never subject to tax. They might be subject to tax at a state level from that issuing state, possibly, but they are never subject to federal tax. Any capital gains from the sale of these, though, is subject to federal tax. To convert municipal bond interest to fully taxable equivalent rate, what they say is divide the municipal rate 1 minus the tax rate. So if the tax rate is 35% and municipal bond 5% is really the same as earning a 7.7 corporate bond. Because they're not taxable, the interest rates that they have on these are much lower, and they're considered to be much safer bonds. Also, they're typically don't default, so they're considered to be fairly low risk. They're not completely risk-free, but they're low risk. So that kind of mentions that too. They're not risk-free, but they're lower risk than corporate bonds. Revenue bonds are issued by a state but only specified by revenue streams to pay them back. A toll road, a college campus residence hall. Sometimes bonds are used to pay for things like that, and just the revenues from those things being built then is used to pay back the bonds. A general obligation bond is just simply backed by the full faith and credit of the state or the local government that issued it. Interest from private activity bonds issued by states is subject to what they call the alternative minimum tax, but don't worry about that. Corporate bonds are issued by segments of corporations, industrials, public utilities, rail and transportation, finance companies. There's all kinds of examples of big companies that issue bonds. Most are 5 to 10 year maturities, but they can be up to 30 years too. Interest is fully taxable, and they tend to have higher yields because there's more risk. A zero coupon bond is issued at a deep discount but pays no interest. Some cultures this is interest is prohibited, so the solution is a zero coupon bond. So basically, you buy a $1,000 bond for, let's say, $700, and you get $1,000 back, and the $300 difference is your interest. That's kind of what a zero coupon bond will do. So the bond market acts just like the stock market. There's a bond market where, just like a stock market, where you can buy and sell bonds. Convertible bonds allow a bond to be turned into common stock, and the conversion ratio is stated on the bond contract, and that's how you know how many shares of stock one bond can be turned into. Bonds are rated based on the credit rating of the company that issued them. Higher quality bonds typically have a higher rating and have a lower rate of return because, again, we're trying to match risk and return. So a bond from a very highly rated company like a Google or an Apple or something like that would have very low risk. Junk bonds are bonds that have very low ratings. They pay high interest rates, but they're very risky. The rate of default is high, and the rate of not receiving your interest payments is very high. So bonds are rated by two different ratings agencies, Moody's and S&P. S&P stands for Standard & Poor's. And you can see what the ratings rankings are here, what the different letter codes are. You can look at that on your own. Bond pricing is based on a percent of par value. So if a bond sells at 95, that means 0.95 or 95% of the par value. So a bond selling at 95 is 0.95 times 1,000, which is 950. A bond is sold at a discount when the market rate is higher than the stated rate of the bond, and a bond is sold at a premium when the market rate is lower than the stated rate of the bond. So the interest rate in the economy compared to the stated rate of interest on the bond is what drives the price of a bond. The yield on a bond is simply the annual interest divided by the market price. That's the yield that you would return. Then bond pricing at yield to maturity. The formula here is you take your coupon income, your stated rate of interest that you earn, plus $1,000 minus the current price, divided by the number of years to maturity when that bond will mature, and you divide all that by the current price of the bond plus 1,000 divided by 2, and that gets you your yield to maturity, basically the return that you will earn if you hold the bond until it literally matures, if it's 10 years from now, 30 years from now, whatever that date is. So if a bond is purchased at face value, yield to maturity will equal the coupon rate or the stated rate. If the bond is purchased at a discount, the yield to maturity will be greater than the coupon rate. If the bond is purchased at a premium, yield to maturity will be less than the coupon or stated rate. Okay, so there's a lot there to throw at you. The bond part's a little bit more complex than the stock stuff probably. When you do the work in Cengage, you'll be doing a lot of ratio analysis. So as you see some of the ratios that I threw at you in this PowerPoint, and as you read the chapters, kind of make note of the ratios that are there, because there's a good chance then you'll be using those ratios to calculate with some of the data that they give you in Cengage. And if you have questions about anything,